Gordon Brown was Chancellor of the Exchequer from 1997 to 2007. He then was the Prime Minister from 2007 to 2010 after Blair resigned. He was the longest-serving Chancellor in recent history and presided over the longest period of economic growth in modern UK history. Significant investments were made in the NHS during his time, and waiting lists came down quite significantly. He outlined 5 economic tests which resisted Britain joining the euro. He made major reforms, transferring interest rate setting to the Bank of England and transferring banking supervision to the Financial Services Authority. However, he also made some policy mistakes which have affected the UK economy so much that warrants more scrutiny. Here we outline some of the policy mistakes that we think are important in the context of current UK economic problems. Private Finance Initiative. Although the PFI idea was first promoted by the Conservative government under John Major, it was expanded significantly during the time when Mr. Brown was Chancellor. PFI was designed to leverage private sector expertise and capital for the development, maintenance, and operation of public facilities. Over the decades, PFI has played a central role in funding and managing a wide range of projects, from hospitals and schools to transportation infrastructure. The fundamental premise of PFI is a public-private partnership, PPP, where private entities are responsible for the comprehensive handling of public projects. This includes the design, construction, financing, and management of facilities, with the public sector retaining ownership through a leasing arrangement over typically 25 to 30 years. Although this enabled significant public investment on essential infrastructure which the UK needed, concerns have been raised regarding the overall costs of these PFI projects. By integrating private investment, the government aimed to circumvent public sector borrowing constraints, thereby accelerating infrastructure development without immediately impacting public sector debt figures. However, the longer-term costs, as we realize now, are huge. Here are the reasons why PFI is not a good idea. High costs. PFI projects typically incur higher costs than conventional public procurement, mainly due to the higher cost of private finance. Inflexibility. Long-term contracts can be highly inflexible, making it costly for public entities to modify projects in response to changing needs. Value for money. The higher financial costs and the complex nature of PFI deals have led to debates over whether these projects truly offer value for money to taxpayers. Transparency issues. PFI contracts are often criticized for their lack of transparency, making it difficult for the public and even for some parts of government to scrutinize terms and ongoing performance. There are over 700 operational PFI and PF2 deals, with a combined capital value of around £60 billion. Annual charges for these deals amounted to £10.3 billion in the fiscal year 2016-17 alone. The future financial commitments extend into the 2040s, with expected future charges totaling approximately £199 billion. This is based on the existing contracts that will continue to accrue costs over their lifespan, despite no new deals being entered. These payments cover a range of expenses including debt repayment, financing costs, maintenance, and other operational services provided under the contracts. PFI is compounding the damaging effects of austerity, which introduced regular cuts to NHS capital budgets. Capital investment has fallen off a cliff, as trusts have been forced to reallocate long-term capital funds to patch up day-to-day running costs. In the last 4 years, £4 billion of capital funds have had to be reallocated. These figures illustrate the extensive and lasting financial burden imposed by past PFI and PF2 agreements, impacting government budgeting and fiscal policy for decades. That means toxic PFI contracts are still driving billions away from patients and into private bank accounts. Financialisation of housing and explosion in mortgage lending without adequate curbs. Here we outline an important document called UK Banking 1997-2009, a very old-fashioned crisis by Alastair Milne and Justine Wood. The paper examines the impact of shadow banking and financial innovation, on the UK credit market from 1997 to 2007, leading to the banking crisis of 2007 to 2009. The authors draw parallels between this crisis and past financial disturbances in the UK, attributing the issues to unsustainable lending practices focused on property, mediated by specialized institutions. Shadow banking refers to credit intermediation outside traditional banking, often linked closely with conventional bank credit extension. Despite its name, shadow banking in the UK was primarily funded by traditional banks rather than independent money market funds. Using Bank of England data, the paper traces the growth in UK credit, particularly highlighting the role of shadow banking. Notably, it discusses the increase in intermediate financial corporations' activities, which saw substantial growth from 2003 to 2008. This chart illustrates the growth in broad money supply relative to GDP, which underscores the rapid expansion of credit in the years leading up to the financial crisis. The data shows a significant rise in broad money, especially from 2002 onwards, reaching a peak just before the crisis in 2008. The growth of shadow banking leads to increased systemic risk, particularly through short-term funding mismatches and the concentration of credit in property markets, both residential and commercial. Regulatory responses to shadow banking and increased financialization was inadequate. Gordon Brown admitted later that he was under intense pressure from the city not to overregulate. The creation of the FSA, which failed to understand the risks posed by overleverage and the entanglements of various institutions with each other, has been attributed as one of the reasons for the crisis. The UK's financial crisis was fundamentally a traditional one, driven by property lending and the use of complex financial products that played only a minor role compared to the core issue of credit expansion against property. The other thing we want to point out was an article from Financial Times by Jim Pickard, who pointed some of the blame on the financial crisis on Mr. Brown. This include changing the Bank of England's inflation target from RPI to CPI, which does not include house price inflation. This enabled the Monetary Policy Committee to cut interest rates much further in recent years. This allowed people to borrow more. Shifting planning guidelines for new homes from greenfield to brownfield. Though well-intentioned, this has led to a glut of city center flats, bought mainly by buy-to-let investors. This financialization of the housing prices led to a property boom which has continued to the present time and has not only caused wealth inequality, but also caused a housing crisis for millennials and people who cannot afford to buy a house. Rental prices as proportion of total income have gone up to 30 to 40% depending on location. The bailout of the banks cost the taxpayer £23 billion, and the government had to guarantee a further $1 trillion in loans of financial corporations. Pensions tax raid. In 1997, Gordon Brown abolished the dividend tax credit to increase government income. Studies suggest that the government gets around £5 billion each year. However, this caused significant problems from defined benefit pension funds in the private sector. This raid on the pensions reduced the value of the pension funds by about $100 billion. A 40-year-old man planning to retire in 25 years, making monthly contributions of £250 to add to his current £60,000 pension pot, will eventually lose more than £120,000 on the final value because of the tax relief reforms. This tax raid led to the closure of many private sector defined benefit schemes and has created a pensions time bomb for the future. It also made the pension funds move their investments from shares to government bonds. We can be sure that from the 2022 bond market crisis, some of these funds would have lost value from losses from the fall in the value of bonds. Selling UK gold reserves. Gordon Brown sold half of UK's gold reserves between 1999 and 2002. Gold had been in a 20-year bear market. Gordon Brown was worried that it might fall further, and so he wanted to sell the gold. Originally, this was meant to be a secret, but the planned sale was brought up in the House of Commons and gold prices fell by $10 immediately. They sold the gold in 17 auctions, and because of this, the Treasury lost about $100 million. However, if the gold had been sold at current prices, then it would have been worth many billions more. Gordon Brown was also advised by Bank of England not to sell the gold, but he ignored the advice. Selling off the Treasury estate. Gordon Brown sold off most of the Treasury estate to a private company in a deal called STEP's strategic transfer of the estate to the private sector. In 2001, the HMRC transferred most of its estate, about 574 buildings, to Mapelei in a 20-year PFI deal. Mapelei paid £220 million for this, with an additional £170 million paid over 10 years through reductions in annual charges. In return, the Treasury estimated to pay Mapelei $3.3 billion over the course of 20 years. However, actual payments have exceeded initial expectations by 20%, totaling about £3.87 billion. The extra costs arose due to changes in building specifications, enhanced service provisions, and slower utilization of property vacation allowances. This contract aimed to transfer ownership and management of 60% of HMRC's estate to Mapelei. There are also concerns regarding Mapelei's decision to transfer the ownership of the estate to a company based in Bermuda, an offshore location. This move was made after signing the contract with the department, and it meant that any capital gains from the sale of the properties would not be subject to UK taxes. In closing, Gordon Brown's era as Chancellor is marked by notable economic fluctuations attributed to rising house prices and low inflation, driven by inexpensive goods from China and labor from the EU. While some may tout the economic prosperity during his tenure, these factors suggest a nuanced reality where policy decisions also paved the way for significant economic losses. This analysis invites a deeper reflection on his policies, leaving you to draw your own conclusions about his effectiveness and the long-term impacts of his economic strategies.